The Tel Aviv property market experienced significant corrections during the third quarter of 2025, marking a notable shift from the strong growth patterns observed in previous years. Average property prices in Tel Aviv reached 3.68 million shekels, representing a substantial 13% annual decline compared to the same period in 2024. The broader Tel Aviv district recorded an average price of 3.01 million shekels, down 7.6% year-over-year, with a quarterly decline of 0.9% from the second to third quarter. This correction represents a natural price adjustment from the historically elevated valuations recorded throughout 2024, influenced by multiple economic and geopolitical factors. The market shift reflects broader economic factors that have fundamentally altered buyer behavior. The Bank of Israel maintained interest rates at 4.5% throughout the third quarter, resulting in elevated mortgage costs averaging approximately 5%, which significantly impacted buyer affordability. Ongoing regional security concerns, including the June 2025 hostilities with Iran, dampened buyer confidence. Perhaps most dramatically, the market faces a record inventory of 83,920 unsold new homes nationwide at the end of the third quarter, representing an unprecedented 28.8 months of supply. The Central District alone holds 26,740 unsold units, the highest inventory level in Israel. Despite declining prices, transaction volumes showed signs of recovery, suggesting that market corrections have attracted buyers seeking value opportunities. Nationwide transactions reached 23,330 units in the third quarter, representing a 15.4% quarterly increase from the second quarter. New home sales proved particularly robust, totaling 8,780 transactions and reflecting a 23% increase over the previous quarter. Tel Aviv Jaffa itself recorded 608 new unit sales, a striking 53% increase from the second quarter, largely attributable to the substantial release of units at the Say Dov development project. The price correction has affected different property types with varying intensity. Large apartments of 4.5 to 5 rooms experienced the steepest decline, dropping 26.4% from first quarter levels to an average of 5.18 million shekels. This dramatic correction in the premium segment reflects both oversupply in luxury developments and reduced purchasing power. In contrast, small units of 1 to 2 rooms actually appreciated 4.6% during the same period, rising to 2.98 million shekels, demonstrating sustained demand for entry-level properties. Standard 3 to 4 room apartments declined more moderately by 7.2%, averaging 3.85 million shekels. Neighboring cities within the Tel Aviv metropolitan area demonstrated divergent performance patterns. Herzliya, Israel's second most expensive city at 3.66 million shekels average, experienced only a 4.2% annual decline and remarkable quarterly stability. Ramat Gan averaged 2.92 million shekels with a 5.7% annual decline. Most remarkably, Bat Yam defied broader trends with a 4.2% annual increase and 8.3% quarterly surge to 2.47 million shekels, demonstrating that value-oriented markets near Tel Aviv continue attracting buyers priced out of premium areas. The rental market has remained remarkably strong despite purchase price corrections. Existing tenants renewing leases experienced 2.5% rent increases, while new tenants entering the market faced more substantial 5.5% increases. Gross rental yields improved to 3.38% nationally in the third quarter, up from 2.53% in the second quarter of 2024, as rental income remained stable while purchase prices declined. Regional price changes across Israel reveal Tel Aviv's correction as part of a broader market divergence. Jerusalem posted an 8.0% annual increase to 2.9 million shekels, bucking the national correction trend. The Northern District demonstrated the strongest appreciation at 9.5%. Haifa District grew 5.1% to 1.88 million shekels. The Central District declined 3.8% to 2.61 million shekels, affected by its proximity to Tel Aviv's correction dynamics. Developer behavior has shifted significantly as market conditions deteriorated. By September 2025, 31% of new apartment transactions included developer financing incentives, up from 27% in August, indicating builders' increasing willingness to offer favorable terms to move inventory. These incentives typically include extended payment schedules, reduced down payment requirements, or subsidized mortgage arrangements. The market entered the third quarter following 7 consecutive months of national price declines through September, representing the most sustained correction period in recent Israeli real estate history. Annual housing price growth nationwide reached only 0.5% by the third quarter, down dramatically from the 7.8% peak recorded earlier in the year. The taxation environment contributed to unusual market dynamics. The VAT increase to 18% in January 2025 accelerated late 2024 purchases, artificially inflating fourth quarter 2024 transaction volumes. Construction costs also increased substantially, with the Residential Construction Cost Index rising 5% over the 12 months through October 2025, driven primarily by 9.2% labor cost increases. Economic conditions beyond the property market have contributed significantly to the current correction. Israel's second quarter 2025 GDP contracted 3.5% year-over-year, influenced substantially by the 12-day hostilities with Iran in mid-June. The Bank of Israel revised its 2025 GDP growth forecast downward to 3.3% from 3.5%. For prospective buyers, the current market environment presents both opportunities and risks. The 13% annual price decline in Tel Aviv proper creates potential entry points for those with stable employment, adequate financing, and long-term holding horizons. Mid-range properties in the 3 to 4 room segment appear particularly attractive given 7.2% price reductions. Buyers should prioritize properties in established neighborhoods with strong rental demand characteristics. Sellers face a challenging environment requiring realistic pricing aligned with current market conditions rather than 2024 peak valuations. The 28.8 months of unsold inventory nationwide demonstrates the extent of seller-buyer price disagreement. Strategic sellers should consider the opportunity cost of delayed transactions, factoring rental income potential against holding costs. Investors must carefully evaluate the risk-return profile given current market dynamics. The improved gross rental yield of 3.38% reflects better cash flow characteristics. However, investors must account for elevated supply levels that may pressure both prices and rents. The divergent performance across property types suggests targeted strategies focusing on small 1 to 2 room units that demonstrated appreciation and strong rental demand. The market's trajectory through late 2025 and into 2026 will depend on several key variables. Monetary policy decisions represent the most immediate catalyst, with any movement toward interest rate reductions potentially stimulating buyer activity. Resolution of geopolitical tensions would remove a significant psychological barrier. Most fundamentally, the pace at which the substantial inventory overhang is absorbed will determine whether current price levels represent a bottom or merely a waypoint. The construction industry faces particular stress, with builders caught between elevated costs incurred during the boom period and current market prices. Dwelling completions dropped 8.8% year-over-year to 12,017 units in the first quarter of 2025. The 188,811 dwellings under construction represent substantial future supply that will enter the market over coming quarters. Technology sector dynamics deserve particular attention given Tel Aviv's positioning as Israel's premier tech hub. Global technology markets experienced significant volatility during 2022 through 2024, affecting employment and compensation levels among the professional class that historically drove demand for premium Tel Aviv properties. Foreign investment from diaspora communities represents an important but variable demand source. The strong shekel against major currencies affects foreign buyer calculations significantly, with currency movements sometimes overwhelming property price changes in determining relative value. The market demonstrates clear bifurcation between new construction and resale properties. The 53% surge in Tel Aviv new unit sales despite overall market weakness suggests that properly positioned and priced new construction can outperform the broader market, particularly when developers offer incentives. Transaction costs in Israeli real estate remain substantial, with purchase taxes, legal fees, and agency commissions typically totaling 8 to 10% of property value for non-first-time buyers. New immigrants benefit from substantial tax breaks on first property purchases up to 6 million shekels. Properties with protected rooms command measurable premiums in both sale and rental markets, with recent reporting indicating 3,000 shekel monthly rental premiums in Tel Aviv for units with safety features. This safety premium represents a structural shift in buyer and tenant preferences post-October 2023. Looking forward, the Tel Aviv property market appears positioned for continued near-term volatility as the substantial inventory overhang is absorbed. Buyers with long-time horizons and tolerance for continued near-term price weakness may find current conditions present attractive entry opportunities. Sellers should carefully evaluate the opportunity cost of waiting for market recovery. Investors must approach the market with realistic return expectations focused on income rather than appreciation. The market ultimately reflects the intersection of numerous complex factors: interest rates, geopolitics, demographics, psychology, policy, and economics. What appears certain is that the Tel Aviv property market has entered a new phase characterized by greater uncertainty, more balanced buyer-seller dynamics, and return expectations grounded in fundamental value rather than extrapolated appreciation. Stakeholders who approach this environment with realistic expectations, thorough analysis, and appropriate risk management will be best positioned to navigate whatever market conditions ultimately emerge.